Transformative Learning and Action Institute's Apply It webinar series. Today we have the pleasure of being joined by Leora Klapper and Douglas Randall from the World Bank. Leora Klapper is Lead Economist in the Finance and Private Sector Research Team of the Development Research Group at the World Bank. Since joining the bank as a Young Economist in 1998, she has published on entrepreneurship, access to finance, corporate governance, bankruptcy, and risk management. Her current research focuses on entrepreneurship and household finance and measurements of financial inclusion. Prior to coming to the bank, she worked as the Board of Governors of the Federal Reserve System, the Bank of Israel, and Salomon Smith Barney. She holds a Ph.D. in financial economics from New York University Stern School of Business. Douglas Randall is a research analyst in the Finance and Private Sector Development Team of the Development Economics Research Group. He joined the bank in 2009 and is currently the lead data analyst for the Global Financial Inclusion Global Findex database. He has a BA in Political Science and Economics from Tufts University and an MS in Applied Economics from Johns Hopkins University. Today, Leora and Douglas will share what the latest data says about the state of youth financial inclusion. And with that, I'm going to turn it over to Leora and Douglas.
Thank you for the introduction, and thank you for joining us today. If you have any questions along the way, please type them into the chat box. We'll try to answer them either in real time or when the conclusion of the presentation. And so we're going to be speaking today about financial inclusion. This is the use of formal financial services that allows people to smooth their consumption and insure themselves against the many economic vulnerabilities that they face, from illness and accidents to theft and unemployment. Financial inclusion allows particularly the poor to save and to borrow, allow them to build their assets, to invest in education and entrepreneurial activities, and improve their livelihoods. There's also a growing empirical academic literature showing that providing individuals access to saving instruments can increase savings within the household, can improve female empowerment. When a woman comes home, for example, if a woman has a bank account and doesn't come home with cash in her pockets, the woman has greater decision-making over household expenditures, particularly on healthcare and education, in productive investment, and in consumption. Policymakers are increasingly committed to promoting financial inclusion. The G20 created the Global Partnership for Financial Inclusion at their summit in Los Cabos, Mexico in 2012, and in St. Petersburg in 2013, endorsed greater recognition of the importance of data to benchmark and to measure financial inclusion, and improved an expanded set of financial inclusion, a set of indicators that countries should collect to track their progress over time. According to a recent survey of bank regulators in 143 countries, 67% of regulators are now charged with promoting financial inclusion. So going beyond simple financial stability and fragility, also interest by regulators and government officials in usage and access to financial services. And most recently, last Friday, the World Bank President Kim announced a new initiative to provide universal financial access to all working age adults by 2020. And clearly, it's important to have the data to be able to measure and benchmark progress on this front. And so recognizing the need for better data to support the financial inclusion agenda, the World Bank's Development Research Group, with a 10-year grant from the Bill and Melinda Gates Foundation, has partnered with Gallup Incorporated to construct the Global Financial Inclusion, the Global Findex indicators. And so the goal is to collect comparable cross-country data on financial inclusion by surveying individuals around the world. Again, the goal is to have consistent methodology, consistent sampling across countries, and to survey on the individual level. So this allows us to identify the segments of the population with the greatest barriers to access to finance, those most vulnerable, such as the poor, youth, women, and rural residents. This will be collected over time, every 3 years through 2017, at least. So we were able to develop a database to motivate and track policies to expand financial services to the poor. And most importantly, our questionnaire is designed to collect consistent, harmonized, comparable data around the world. And so we include 41 indicators on the use of financial services on payments, savings, credit, and insurance. And I will add to the chat box right now for you to look at later. I'll add it at the end, the link to our website where we have all of our publications, our notes, as well as the complete data set on both the country and on the individual level. And so to get into specifics, the design of our questionnaire is we added on a module of financial inclusion to the Gallup World Poll. This is a pre-existing survey which Gallup has run since 2006 in up to 160 countries around the world using consistent methodology, harmonized sampling, etc. And so in 2011, our survey was conducted in 148 countries. I like to say we're the only database that asks the same questions on financial inclusion in both Australia, Afghanistan, Sweden, and Somaliland. It represents 97% of the world's adult population, ages 15 plus. The survey was translated into 141 languages. A dozen languages are available on our website. All others are available upon request. And we surveyed at least 1,000 nationally represented individuals in each country, and more so in the BRIC countries, China, India, Russia. And so here's our flagship map showing that over 2.5 billion adults around the world lack a formal account. 59% of adults, almost 2.5 billion people living in developing economies don't have a formal account, compared to just 11% of adults in high-income economies. We survey, importantly, as I mentioned before, we survey individuals and not households. And so we can splice and dice the data by individual characteristics such as gender, income, age, education, urban versus rural residents. And quite importantly, we ask about ownership of the accounts. Do you personally have an account that you can personally deposit into or withdraw from? And again, we think that asset account ownership is important for economic empowerment, particularly among youth, women, and others. And so, as I mentioned, we find 37% of women in developing economies are banked, compared to 46% of men, and 23% of adults living below $2 a day. The absolute poor have a formal account. And so here's just looking at it spliced a little differently. Here we look at it by income level. And less than a quarter of adults in low-income economies have an account, compared to almost 90% in high-income economies. We also ask about the use of how people can access their accounts. We find that 23% of adults in developing economies have a debit card, compared to 62% in high-income economies. This is one of many statistics which we're very excited to update in 2014. Expect to see potentially massive growth in the use of cards as digitalization has become cheaper, and the use of prepaid and debit cards and credit cards has expanded. So next we look at account penetration. Again, there's one more way of looking at it by region. And here again we see large differences between the lower income and higher income economies. As I mentioned, this is the first data to show cross-country differences in financial inclusion by individual characteristics, and finds a large disparity that especially places the poor, women, and youth at a disadvantage. In this figure, we use the complete database, which defines youth as ages 15 to 24. In later analysis, we'll look more carefully at ages 18 plus. But across the age spectrum, we do see a large difference. We find that the top 20% of earners in developing economies are more than twice as likely to have a formal account as the bottom 20% on average. And we also find that women are less likely to be banked than men in every region. There may be a cultural or cost reason or greater sensitivity to traveling distances to reach a financial institution. But taken together, the data suggested that in many countries, it's the head of the household who has an account. As shown in the figure on the right, that in developing economies only, we find a persistent gender gap in financial inclusion by gender across all income groups. For example, even among the richest 20% of earners, there's still an 8 percentage point gap in account penetration between men and women. So here's just a figure to talk for a moment about high-income economies. And this is interestingly consistent with recent studies by the FDIC that show that as compared to other high-income economies. In the United States, the lowest, this is looking at financial penetration among the lowest 20%, the poorest 20% of earners, which is less than 10% less in Canada, less than 5% in Australia and the United Kingdom, whereas it's 26% of the poorest 20% of earners in the U.S. are without an account. Looking more closely, these tend to be female, less educated, and immigrants. And overall, 36% of adults living in the U.S. who are born elsewhere lack access to a formal account. So here we look more closely at account penetration by age group. We find that globally, 44% of youth defined as 18 and older have an account at a formal financial institution. Again, here we resplice the data to look at only 18 plus, since in many countries, in some countries, those under the age of 18 are not allowed to have an account. Also, in general, 18 is when youth perhaps begin living on their own or attending university and have more of a demand for financial services. We find that 83% of youth in high-income economies have 18 and plus have a formal account, compared to only 38% in the developing world. And this gap between young and older adults persists even in high-income economies, as shown at the bar on the right. Next, we look at, and this is figures from our new note on youth, which is now available on our website. The link is available on the top of the chat box. So in Figure 2, we show account penetration in only developing economies, sliced by age group and within economy income quintiles. So that's saying across countries, the poorest 20% of earners, as shown in the bar on the left, as compared to the richest 20% of earners, shown at the bar on the right. And again, this is highlighting that in developing economies, this age gap in account penetration persists even across income quintiles, even within the richest 20% of earners. And so what drives the differences in account penetration around the world? Well, GDP per capita can explain a lot. Around 73% of the variation in the country level for the entire sample, as shown in our graph. However, take a closer look at the yellow bar on the right-hand side. That's the bottom 50% of country GDP, so below about $2,436 US dollars. So those countries with GDP per capita below about $2,500 US dollars, there only 15% of the variation can be explained by variations in income level. In other words, Cambodia and Bangladesh have the same GDP per capita, about $500 US dollars, but a penetration rate of 4% and 32% respectively. So within our sample of lower and lower middle income countries, we see a huge variation in financial inclusion that cannot simply be explained by country level income. And so we ask people why they don't have an account. And here we show so we asked 700 million youth and older adults in the developing world why they remain unbanked. And so here we show that the reasons which stand out among the youth, first of all, lack of necessary documentation. Because of various AML and other regulations, youth may be lacking documentation needed to get an account. In particular, students who travel to the city, for example, to go to school, may not have residency requirements and other necessary documentation. We also see a high usage reported that another family member already has an account. In other words, youth are still using the account of a parent in their house or other member of their household. And also, the youth appear to be relatively more sensitive to the cost of accounts, more likely to report that the account is too expensive. Interestingly, they're actually less likely than older adults to report that the reason not having an account is a lack of money, which at least is suggestive that there is a demand for accounts among youth. In the next slide, we look at, we also ask the question on the usage of accounts for savings. And so more generally, we asked, have you saved in the past 12 months? Have you saved formally at a financial institution versus using other methods, such as a Rosca, a merry-go-round, or simply under the mattress? And we find that 31% of adults in developing economies saved in the past year. and that 56% of these savers in developing economies use a formal financial institution. The remaining use either a semi-formal product such as a Raska or simply under the mattress or in some other asset. And interestingly, 48% of savers in sub-Saharan Africa saved using a community-based method. And that's interesting because the commitment to being able to save on a regular basis, again, is suggestive of the ability to formally save if the correct products were designed and offered. And so just to hone in on in Africa, again, what's interesting here is that among these 48% of savers in sub-Saharan Africa that save using community savings club, we still see great variation even within Africa. Again, interestingly, 53% of women who save in sub-Saharan Africa do so using an informal savings club, compared to 43% of men who save, which again highlights this demand, particularly by women in Africa, for a safe place to save outside of their household. And so here's figure 4 from our new savings note. It shows formal savings in developing economies by age group and within economy income quintiles. So this is similar to the previous figure, which looks at savings among youth versus older adults for the poorest income within country income quintiles, which is suggestive that, again, if you look at the figure, the bar to the far right, it's showing that even among the richest 20% of earners, you still see this very large gap in the use of informal savings between youth and older adults. And so, as shown, a larger share of youth in developing economies report borrowing, 34%, than report saving, it's only 29%. And so next we look at mobile money users in Africa. And here this is money transfers through mobile phones, which allow account holders to pay bills, make deposits, or conduct other transactions using a cell phone, which has taken over 16% of the market in sub-Saharan Africa, where traditional banking has been hampered by transportation and other infrastructure problems. Interestingly, in sub-Saharan Africa, on average, 18% of men report using a mobile phone to pay bills, send, or receive money, compared to 15% of women. However, the difference disappears among youth. For those ages 15 to 25, 15% of both men and women report using mobile money. It'll be interesting to watch as this group matures to see if the technology, by reducing transportation and other costs, also can help reduce the gender gap. So importantly, 52% of adults in sub-Saharan Africa who use mobile technology are otherwise unbanked. In Kenya, for example, where 68% of adults report using mobile money, 43% of mobile money users do not have a formal account. This suggests that mobile money is still often used as a substitute for formal financial services. It's also important to note that the average use of mobile money transfers for all developing economies is only 5%, suggesting that there are still barriers to the introduction of new technologies in other regions. I'll also mention here that we're quite excited to have received additional funding from the Bill and Melinda Gates Foundation to add to our module in 2014 additional questions specifically on payments, specifically on how people send and receive money from family and friends, how people pay bills, and how people receive government payments and wage payments. And we're specifically interested in tracking over time the introduction of new ways of new electronic payments, such as mobile technology, such as direct deposit, and this data will be released in the spring of 2015. And so to conclude, this data could be useful for policymakers, bankers, NGOs, donors, and researchers, anyone interested in a holistic understanding of how adults around the world use financial services. As I mentioned, we've secured additional funding to expand, almost doubling the size of our questionnaire to include additional questions on payments, specifically on mobile banking, and how people send and receive domestic remittances, make bill payments, and receive their wages and government transfers. And finally, we hope you will visit our website, where we have a variety of all various publications, both full research reports, We're up to, I think, number 13 of our short Findex notes series, a little data book of financial inclusions, and lots of tools to graph, map, and download the data. Importantly, the data is available both on the country level, spliced by individual characteristics, gender, age, income, and education, as well as the complete micro database, all 150,000 adults for all variables, plus the key demographic covariates are available to download by country or for the world. So we hope that you'll use the data, explore the data, and that our data can help make a difference. We'll start taking questions now, either in the chat room, the questions have been asked, or please send us new questions.
I'm going to pop in here. Doug Randall, we've been getting a few questions already in the chat that we'll take the opportunity to answer while folks are catching up and asking their own questions. So an early question was, I think, about methodology and a little more detail about how we've managed to harmonize the questionnaire and data collection process across countries. An important part of this project, as Leora mentioned, is that we partner with Gallup and their Gallup World Poll, who have been doing this survey, the World Poll, in over 150 countries since 2005. So they've gained an enormous amount of experience in sort of standardizing everything from questionnaire development to methodology to sampling, respondent selection, interviewer training across countries. And of course, it should go without saying that there are enormous differences and challenges in each country, and it's difficult to sync them all up. But they do go to enormous lengths. They use the exact same sampling methodology. All the interviewers are trained using a consistent training module. Every survey is translated by professional translators and then back translated to ensure consistency with the original English text. We'd be happy to answer any further questions about methodology or how else we can ensure consistency. But the short answer is we use the same questions and the same methodology in every country. There was another question about motivations for informal savings, and this is, of course, an extremely interesting topic. Unfortunately, the survey instrument itself, because of space limitations, doesn't delve too deeply into the motivations behind why people are using these informal savings clubs. But as Leora mentioned, we're in the process of expanding the global Findex data, and part of that process has been this summer to spend a lot of time piloting new questions as well as making small revisions to the 2011 questions. So as many people were, we were surprised by sort of the enormous use of these informal savings mechanisms, be they, as Leora mentioned, ROSCAs, rotating savings and credit associations, merry-go-rounds. They sort of go by different names in different countries, but maintain a lot of the same basic characteristics, wherein people go to a weekly or monthly meeting, they contribute some amount of money, and each meeting somebody goes home with the entire pot of money. And this is an important savings mechanism, not only for people who are outside of the financial system, but also the data supports this. We see a lot of people who have an account, but are also still using these informal systems to save. And so while we were traveling in the developing world this summer, particularly in East and West Africa, we kept asking folks why they're using these informal mechanisms alongside an account if they have one. And it's really interesting to hear. A lot of people are attracted to the ROSCAs because of their formality and more of the commitment device inherent. When you have an account, you contribute when you can, but that sort of introduces your own sort of motivation factor. But when you have a commitment every month and you're usually with a circle of friends or family, it drives people to set aside the money in order to save. And there's sort of a social pressure aspect there as well. And we heard time and time again that people would use these informal mechanisms to save on a monthly basis, and then once they win, the entire pot, let's say, they would then take that to the bank and put it there. So it's often used as sort of an intermediate way to save for the short term, whereas banks are often viewed as more of a long-term savings mechanism. Some others, again, some more anecdotal evidence about why people use these. Again, lack of financial access is important. These groups are almost always in a person's neighborhood, so proximity is an issue. And again, sort of the social aspect. So let's see if we have any other questions.
To answer Karen's question, yes, the Community Savings Club data can be sliced by age. I don't have the data.
Yeah.
We could quickly summarize that for you. But again, you can use either in a country level database that's available, that variable, semi-formal savings is available by age, by gender, by education, and by within country income quintiles, or you can download the data and slice the data by whatever age categories you wish.
Just a very quick back of the envelope calculation shows that worldwide about 17% of youth savers are using some sort of informal mechanism to save, sort of the person outside the family or ROSCA. But again, as Leora mentioned, the micro data is available on the web, and please also feel free to email us if you have more specific data questions. We'd be happy to run some statistics for you.
And regarding the question on the linkages between formal and informal savings mechanisms, specifically, as Doug mentioned, this was one of the puzzles which we weren't sure about. You like to hear in policy circles, got this graduation from informal to formal services. Now, why would someone who had a bank account, who even reports saving formally, ever use an informal savings club or other informal savings mechanism? And so, for example, in Ghana, where susus are very popular, which works a little different from a ROSCA in that informal agent picks up cash daily or weekly or semi-weekly from an individual, and at the end of the month, often, for example, in the daily scheme, will keep a one-day savings as a fee, and then return the whole amount to the saver at the end of the month. And so we asked people, why are you using these informal, costly, these negative interest rate savers, susus, if you have a bank account, if you save at the account? What she told us that there were costs involved, that her cost had a minimum deposit, that she had to travel to the bank, that there were other deposit-related fees, both literal and also in terms of her cost time. And so what she did was she used the susu on a daily basis to keep the money safely out of her house. And then at the end of the month, when the money was returned to her by the susu, she deposited that amount into her bank. We also heard from people who used similarly susus to save to pay their electric bills. As Doug mentioned, susu can work as a commitment savings, way of tying their hands for savings. She knew she needed to meet a water bill at the end of the month, and so every day she had the susu collect the money necessary, so at the end of the month it was returned to her, less a day savings, and that she knew that she would have the money. That having the money in the home during the month was vulnerable to being borrowed from family or friends, being stolen, and or being spent by herself. The susus and these other informal mechanisms allowed her to commit to the savings to pay her bills at the end of the month. Although I do agree that this, suggests the demand for perhaps this is an optimal product, or perhaps it's just the need for more formalized, less costly products to help the poor commit to the savings goals.
I'll also quickly point out a few of the other interesting findings that we laid out in the note that's available online and at the top there. Almost as interesting as the big differences that we find between youth and older adults. We see big differences in use of formal accounts, big differences in formal savings, big differences in formal credit. There were a few things that we expected to find some differences in, and basically didn't find anything in the data, particularly with regards to sort of more technologically advanced aspects of financial inclusion. So we were expecting to find that youth were more likely to use debit cards, that youth were more likely to use ATMs to withdraw money, that youth were more likely to use a mobile phone to make payments or pay bills, mostly just because we sort of bought into the idea that youth are more prone or able to adapt technological advances and sort of more on the cutting edge of how technology enters all parts of our life. And so in the data, we don't actually see these differences. And one theory is that, it's not that they're not using them more, but there's the two forces are sort of working against each other. One is, it may be that youth are more likely to use these mechanisms, but again, as we've seen, there are also these barriers working against in the opposite direction, which may sort of make the net difference close to zero. So the barriers, as we were mentioned before, lack of documentation, lack of physical access with distance, indirect access through a family member. So this, I think, is an interesting topic, the degree to which youth are financially excluded from the more technologically advanced aspects of financial inclusion. We hope it's an area that researchers look into a bit more and sort of encouraging new and innovative ways for the private sector and public policymakers to explore ways to use technology to bring youth into the formal financial sector. Another point is looking within youth, sort of who within the youth segment is more or less likely to use an account. And in many ways, this mirrors what we see in the general population, older adults. Men are more likely than women, a statistically and economically meaningful gap to use an account. Sort of the older segments within youth are more likely to have an account. Income is also an important predictor of account usage. But there are some differences. So, for example, we see in youth, the gender gap is actually quite a bit smaller than it is in the general population. Some possible explanations are labor force issues. Among older adults, men may be more likely to enter the labor force, which may come with a wage account, therefore widening the account gap there. Also, generational issues related to gender equality may also play a role in what we see as a smaller gender gap within youth.
It's also worth mentioning that age remains statistically significant even after controlling for other individual characteristics such as gender, income, education, etc. And so on the web is available a recent paper I've written with Franklin Allen, Asa Demirchik-Khan, and Soleil Martinez-Perea, where we're looking more carefully at this relationship. I find that age is very much significant both on account ownership as well as the use of accounts for formal savings, and what we refer to as high-frequency usage of accounts, which is 3 or more withdrawals in a typical month. And the idea is using your account for both cash management as well as simply to receive possibly wages or other payments. And so for all 3 categories, we find that age is a statistically significant predictor, again, ownership of accounts, formal savings, and high-frequency usage of accounts, even after controlling for both country fixed effects and other individual characteristics.
There's a question about the link between sort of general income inequality and what we can call financial inequality. And we do see a very strong correlation, as Leora mentioned earlier, between these two things. You can do this very simply with a scatter plot lining up Gini coefficients, which measure overall inequality within countries against, there's a few different ways to slice this. What we use is the difference in account penetration between the highest income quintile and the lowest income quintile within a country. When we do that, we see a very strong correlation, about 0.35 between those two measures. Of course, that's a sort of a simplistic view at it, but it's very suggestive that these two things are linked, and perhaps there's a lot of interplay between them. And this is certainly something that we'll be looking into a lot further, the drivers and the causes of financial inequality. And again, this slide shows that, again, more anecdotal evidence that there is a connection between those two things.
Are there any more questions?
A few more findings from the note that might be worth pointing out. Again, we really encourage everyone to go online and look at the data. It's available in 2 forms. One is the country-level data that you can download, which is fairly user-friendly. And for those who are able to sort of work more closely with data, you can download the entire data set, INSData. It's 150,000 observations, at which point you can sort of make your own classifications of youth. and sort of explore the data very intricately there. A few more interesting findings from the youth note that we put up relate to savings purposes. So again, we see differences in how people save, and we also see differences in what people save for. So in the survey, we asked people whether they save for big purchases in the future, such as a wedding or an education, or if they save for emergencies. And between youth and older adults, we don't see a huge difference between saving for big purchases, which sort of makes sense given that youth are often put in a position where they have to save up for education or any other sort of cost associated with moving out of their parents' home or sort of starting a career. But we do see a big difference in terms of saving for emergencies. So older adults are much more likely to save for emergencies. About 78% of savers, 25 and above, save for emergencies, while the number for youth is less than 70%. It's much lower. So it does sort of show that the focus of what youth are saving for does differ from that of older adults.
And so someone asked an excellent question on whether we have any evidence whether youth leads their parents to accounts or vice versa. From this database, no. I will give a plug for a complementary database collected by colleagues of mine at the World Bank, also with funding from the Bill and Melinda Gates Foundation, which is, I will type in the link right now. If you go to worldbank.org/LSMS-ISA. And so this is a database, it's very large country-level surveys in 5 African countries. That's actually a panel over time. It was also, its emphasis is on the agricultural sector, but it is a nationally representative sample. In Nigeria, for example, it covers 4,000 households, and every member of every household, which is about 15,000 adults in the country. And so we're actually right now looking at that exact question, paper forthcoming, which is exactly that question. So do you see a sort of relationship, is having a household head with an account make other members of the account, particularly youth, more or less likely to have an account? And then the interesting question of changes over time. So for example, of people who add an account, is it because somebody else in their family already had an account? Or is it perhaps because somebody else in the family closed an account or left the household? So more information on that is coming soon. I agree, it's a quite interesting question. So another question about more general policy recommendations. So I put back up the slide where we ask people without accounts, why don't you have an account? Why do you remain unbanked? And so, what really jumps out here is the importance of documentation. As I mentioned earlier, this may simply be residency requirements as youth move to the city from rural areas for job opportunities or education. It may be other forms of documentation as well. And this highlights perhaps the work and success in many countries of offering simplified accounts. FATF, the organization that governs anti-money laundering and documentation requirements globally, has issued an edict that documentation should not be a barrier to financial inclusion among the poor. And so there exists in many countries simplified documentation requirements for small accounts, which may benefit the youth in particular, who perhaps are more likely to have smaller savings at this point in their life cycle. Secondly, the question that family members already have an account and the cost barriers suggests just more broadly the provision of more affordable, accessible bank accounts will allow more people to have accounts in their own name.
And more generally, in 2014, we'll be collecting this data again. So in early 2015, we'll have a time series aspect to this database with 300,000 observations across about 150 countries over 2 years, 2 separate time observation points. So we'll be able to see some suggested evidence of how, specifically within the youth segment, how financial access has changed over this 3-year period. This should hopefully be an interesting tool for researchers and policymakers to trace the effects of reforms and policies. Of course, teasing out cause and effect is always a complex issue, but if we do see some drastic changes in youth financial inclusion, whether it increases or the gap between youth and older adults decreases, we'll be able to look back and say, what's changed in the past 3 years? Have there been any reforms? Have there been new products that have been particularly helpful in bringing youth into the financial system? So we're really excited to have this time series aspect. We think it'll teach us a lot about what's working, what's not working, and sort of the natural pace of trends and any disruptive technologies that are able to sort of bend the curve a little bit.
And just to answer, last question I see on correlation between education levels among youth and ownership of formal and informal accounts. It's a good question. We could look explicitly at this heterogeneous effect, but education is very highly correlated with income. And as we showed earlier, even among the richest 20% of earners in developing economies, we still see this relatively large youth gap, which I expect would be remain significant in more rigorous heterogeneous tests. And then finally, again, we got the question about gender. I'm sorry, let me look at this question. The gender gap in formal versus non-formal financial services. And yes, again, quite interestingly, in Nigeria, we see a majority of women report using some form of semi-formal commitment savings, informal commitment savings outside of their household, about 12 percentage points more than men in Africa. And again, I think this highlights simply the demand, particularly by women in Africa, for a safe place to keep their money outside their home. And if the products could be designed that didn't charge a negative interest rate, it would greatly benefit women. And wonderful research by, for example, Dupas and Robinson, show they introduce in one study, they simply offer a lockbox, a literal box with a lock, to Africans for saving to the African, and the take-up among African women is tremendous. And even more so, they find that has an impact on household expenditures, that offering this box with a lock to women in Kenya actually has a real impact on household budget decisions, particularly on healthcare and education. And so the demand for savings outside the household by women in Africa appears to be quite large and significant.
And you can find additional information, as we mentioned, on gender gaps by taking a look at the data online. You can sort of create your own country mix or look only at the rich or the poor. But I think the point is that we do find gender gaps in almost everything we look at, certainly in account penetration worldwide among the general population. And as I mentioned earlier, that gap does shrink a little bit among the youth segment, but it is certainly present and statistically significant, as Leora mentioned, even after controlling for other individual characteristics.
I'm also adding to the chat box the link to our Findex note on women and financial inclusion. We find that women make up a disproportionately large share of unbanked adults worldwide. For example, in developing economies, women are 20% less likely than men to have an account at a formal financial institution, 17% less likely to have formally borrowed in the past year. Again, that this gap persists across even among the richest earners. The note also discusses some new research we did using country-level data on both de facto and de jure legal barriers to women in all aspects of their life, from inheritance to working outside the household. And our findings at least are suggestive that legal discrimination against women and various gender norms can explain some of this cross-country variation in access to finance for women. And so we encourage you to use the data, the country level and the micro data library to explore these questions more deeply.
All right. Well, Leora and Douglas, thank you so much for sharing the latest on the global Findex data. We'll post a recording of this webinar online on our website, www.youtheconomicopportunities.org. The address for this is also in the chat box in the lower left-hand corner of your screen for any participants who are interested. Our next Apply It webinar, How to Use Mobile Technology to Bring About Social Change, co-hosted by Text to Change, will take place on October 29th. To RSVP, please visit our website, again, youtheconomicopportunities.org. Thank you everyone for attending today's webinar and have a nice day.